SpaceX is an exceptional company, but its IPO should have been a flop. In 2025, SpaceX generated $18.7 billion in revenue, yet investors were asked to value the company at $1.75 trillion, 94 times annual revenue. For context, Wall Street typically values even its biggest winners, companies like Nvidia, Amazon, and Meta, at less than 20 times annual revenue. By traditional Wall Street standards, SpaceX should have been worth perhaps $200 to $300 billion, not nearly $2 trillion. Critics called it a bubble. The IPO did not flop. Instead, SpaceX sought to raise $75 billion, but investors submitted roughly $250 billion in orders. So who was wrong? The investors or everyone else? At first glance, the SpaceX IPO looks impossible to justify. In fact, it looks like a scam. Every technology company worth more than $1 trillion, Apple, Microsoft, Alphabet, Amazon, and Meta, generates well over $200 billion in annual revenue. SpaceX generated just $18.7 billion. The gap is staggering. To reach the revenue of today's trillion-dollar companies, SpaceX would have to more than double its sales every year for the next 4 years. That kind of growth is rare even for startups. For a company already generating nearly $20 billion in annual revenue, it borders on impossible. Yet investors valued it at $1.75 trillion. The valuation wasn't the only thing that seemed unusual. The structure of the IPO did too. Unlike a traditional IPO, where companies often sell 10 to 20% of their shares to create liquidity, SpaceX floated only about 5% of its equity. Fewer shares meant less supply. Less supply meant more competition for the available stock, and more competition helped sustain a higher share price. Structurally, the offering looked less like a traditional IPO and more like a late-stage venture capital funding round. Then, there was Elon Musk. At Tesla, Musk's record-breaking compensation package became the subject of years of shareholder lawsuits and court battles. His reward depended on achieving extraordinary performance milestones. With SpaceX, the economics look very different. Instead of waiting years for performance targets to unlock compensation, a multi-trillion-dollar valuation immediately places Musk's ownership stake among the most valuable in the world, at least on paper. He isn't the only beneficiary. Early investors collectively invested around $19 billion over 2 decades. Overnight, those investments were valued at nearly $1.7 trillion. Naturally, critics asked a simple question: who is paying for all of this? Eventually, the answer could be the public. If SpaceX remains one of the world's largest listed companies, it is likely to be included in major stock indices. Pension funds, retirement accounts, insurance companies, and millions of ordinary investors would eventually own it through index funds. To critics, everything about the IPO raises red flags: an unprecedented valuation, a tightly controlled share float, early investors sitting on enormous paper gains, a founder whose wealth increases immediately. It all looks engineered to maximize value before the company has generated the revenues normally associated with a trillion-dollar business. So perhaps the critics are right. Perhaps this is one of the greatest valuation bubbles in financial history. But there is one problem with that conclusion. It assumes investors were valuing the SpaceX that exists today. They weren't. Critics looked at a company generating $18.7 billion in annual revenue. Investors looked at a company they believed could dominate the future of space, global connectivity, and artificial intelligence. They weren't valuing current revenue. They were valuing total addressable market. And once you understand that distinction, the SpaceX IPO starts to look very different. SpaceX's prospectus often reads like science fiction. It speaks of building the first AI data center in space, establishing a self-sustaining city on Mars, and ultimately helping humanity progress toward a Kardashev Type 2 civilization. Amid the rockets, satellites, and futuristic concepts, one number dominates the document: $28.5 trillion. That is the total addressable market, TAM, SpaceX claims it is pursuing across space, connectivity, and artificial intelligence. The breakdown is striking. About $370 billion comes from space services, $1.6 trillion from global connectivity, and a staggering $26.5 trillion from AI infrastructure and applications. At first glance, the distribution feels heavily skewed. 2 businesses are already established. The third is an enormous bet on a future that has yet to arrive. The first 2 pillars, however, are grounded in reality. Governments and commercial operators already depend on SpaceX to launch satellites and cargo into orbit. Starlink has created demand in markets traditional broadband struggled to reach, including remote communities, aircraft, ships, and disaster zones. In both industries, SpaceX is no longer a challenger, it is a market leader. The AI opportunity follows the same philosophy that transformed those businesses. SpaceX has repeatedly applied first principles thinking to industries constrained by high costs.
Right, first principles is a physics way of looking at the world, and what that really means is you boil things down to the most fundamental truths.
Traditional rockets were discarded after a single launch. SpaceX made them reusable, dramatically reducing launch costs. Satellite internet relied on a handful of large satellites with high latency. SpaceX replaced that model with thousands of low Earth orbit satellites, creating faster, cheaper, and more reliable global coverage. The pattern is consistent. Identify the industry's biggest cost constraint, then redesign the system from the ground up. That same logic now underpins its AI ambitions. Rather than building data centers on Earth, SpaceX envisions placing them in orbit, powered by continuous solar energy and cooled naturally by the vacuum of space. If technically and economically feasible, such infrastructure could reduce one of AI's greatest constraints, the rising cost of computing. Whether that vision succeeds remains uncertain. But for investors, the importance of the $28.5 trillion TAM lies elsewhere. It is not simply a forecast, it is a statement about where the company believes the world is heading. That naturally raises another question. Why did SpaceX make such a massive TAM the centerpiece of its IPO? Because an IPO is not always about selling today's business. For most companies, going public marks the end of a journey. Founders and early investors finally gain liquidity, while public investors buy into a mature company with established earnings and predictable cash flows. SpaceX is taking a different path. It has structured its IPO to discourage early investors from quickly exiting. Rather than maximizing liquidity, the objective is to raise capital for the next stage of growth. And when selling the future, today's revenue becomes less important than tomorrow's opportunity. That is why the total addressable market matters. TAM is not merely a marketing statistic, it is the language of growth investing. History is full of companies that achieved extraordinary valuations long before they generated meaningful profits. Instagram, WhatsApp, and Snapchat were valued in the billions because investors believed they could dominate massive future markets. Rivian followed the same pattern, reaching a valuation far beyond its revenue because investors priced the electric vehicle market it might one day capture. Traditional investors often reject these valuations because they lack earnings and stable cash flows. Growth investors ask a different question, not what does the company earn today, but how much of tomorrow's market could it own? That shift changes everything. Instead of valuing current performance, investors begin valuing future scale. A company generating $18.7 billion in revenue is no longer measured solely against today's financials. It is measured against the size of the opportunity it could capture over the next decade or more. That is why the $28.5 trillion TAM appears so prominently throughout SpaceX's prospectus. If investors believe that market exists and believe SpaceX can capture even a small share of it, then today's valuation becomes less a reflection of current revenue than an advance payment on future dominance. In other words, SpaceX is not asking investors to value the company it is today. It is asking them to value the company it believes it can become. That is the bet, and ultimately, every investor considering the IPO must decide whether that future is visionary or simply too ambitious to believe. The critics of SpaceX's IPO are asking the wrong question. The debate almost always begins the same way. How can a company generating less than $20 billion in annual revenue possibly be worth $2 trillion? It is a fair question, but it is not the most important one. Critics are not questioning whether SpaceX is an extraordinary company. That debate was settled years ago. It built the world's first truly reusable orbital rockets, transformed the economics of launching satellites, and created Starlink, the largest satellite internet constellation ever deployed. Today, it dominates commercial launch services while simultaneously building technologies aimed at making humanity multiplanetary. Ironically, none of that is the controversial part. The real controversy lies in AI. Nearly 90% of SpaceX's claimed $28.5 trillion total addressable market comes from AI-related opportunities. Remove AI from the equation, and much of the valuation narrative begins to unravel. Some of those ambitions are believable. Building AI infrastructure, massive data centers, and computing capacity fits naturally. with SpaceX's expertise in engineering, energy, and large-scale infrastructure. If executed well, it could become one of the largest investment opportunities of the coming decade. Other opportunities also appear realistic. Its AI products, including Grok and recent acquisition of Cursor, give it a path into AI consumer subscriptions, while its ownership of X provides an avenue into digital advertising. Together, AI infrastructure, subscriptions, and advertising represent roughly $3.8 trillion of the company's AI opportunity. The real leap begins with enterprise AI. SpaceX attributes approximately $22.7 trillion, almost 80% of its total addressable market, to enterprise applications. That is where the story becomes much harder to defend. Enterprise software is one of the most entrenched industries in the world. Microsoft, Amazon, Oracle, Salesforce, and countless enterprise software companies have spent decades building customer relationships, cloud infrastructure, distribution networks, and integrated AI products. SpaceX, by comparison, has no meaningful enterprise AI platform competing in that market today. Even if investors are valuing SpaceX based on its future potential, there is a fundamental question they cannot ignore. How do you value a company based on dominating a market it has not yet entered? That is why many critics dismiss SpaceX's $2 trillion valuation as unrealistic. Yet writing off SpaceX entirely may be just as short-sighted. Because history suggests that betting against the company has rarely been a profitable strategy. SpaceX possesses three advantages that dramatically improve its odds of success: capital, customers, and leadership. The IPO alone raised approximately $85.7 billion, nearly 3 times the capital SpaceX accumulated over its previous 24 years as a private company. That changes the equation. SpaceX operates in some of the most capital-intensive industries on Earth. More capital means more satellites, more launch capacity, larger AI infrastructure, faster expansion, and greater strategic flexibility. Combined with its new multi-trillion-dollar valuation, the public company now has access to financing options, such as using its stock to secure cheap debt or fund acquisitions that were previously unimaginable as a private company. Capital alone, however, does not build great businesses. Customers do. Unlike many ambitious startups, SpaceX is not searching for product-market fit. It already generates nearly $19 billion in annual revenue from launch services, government contracts, and Starlink. Even more important is demand. The company reportedly has an order backlog approaching $80 billion, roughly 4 times its current annual revenue. Whether every contract ultimately materializes is less important than what the backlog signals. Customers already want more than SpaceX can currently deliver. The challenge is no longer creating demand. It is expanding supply quickly enough to meet it. Then there is the final advantage: leadership. Ultimately, investors are not simply buying rockets, satellites, or AI infrastructure. They are buying Elon Musk's ability to execute. His track record is difficult to ignore. He helped build PayPal, transformed Tesla into one of the world's most valuable automakers, and built SpaceX into the dominant commercial launch company, despite years of predictions that it would fail. That history does not guarantee future success, but it changes how investors assess risk. So, is SpaceX a scam? The evidence suggests otherwise. Is its valuation aggressive? Absolutely. The AI assumptions, particularly around enterprise software, remain difficult to justify based on the company's current position. Investors should recognize that much of today's valuation depends on businesses that SpaceX has yet to build. Yet the company also possesses something few startups ever have: extraordinary capital, proven customer demand, and a management team with an unmatched record of executing ambitious visions. SpaceX does not need to capture all $28.5 trillion of its addressable market to reward investors. It only needs to capture enough of it. That is why the IPO should not be viewed as a fraud or as a certainty. It is something far more interesting. It is one of the largest, boldest, and most expensive bets on the future ever offered to public investors.